The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
U.S. stocks finally starting to feel that Christmas spirit. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking off to the closing bell here in the U.S. on this Monday on Christmas week. The S&P 500 higher by about 0.4%. Volume, let's not talk about that. Way off a cliff. The Nasdaq 100 also higher. You can see it's the S&P 500 leading your big tech index right now. A little bit of a sell-off underway in the bond market, if you can even call it that. 10-year yields higher by about 2 basis points right now on your 10-year yield, trading at 416. And the volatility index, your VIX, currently moving lower right now. We're trading with a 14. It'll be interesting to see if we move much lower than these levels this week, Romaine.
Yeah, green and red there. First time I really noticed it, Katie, but Christmas colors all year round. And we talk about that Santa Claus rally, a trope that officially isn't supposed to kick off until December 24th. But St. Nick coming a bit earlier than planned after a 2% drop in the S&P over the first 2.5 weeks of December. The benchmark's now rallied 2% over 3 days, pushing the S&P toward an 8th straight month of gains. That's going to be the longest win streak going back to 2017. But while the best performers, of course, to start the year from the Liberation Day lows of April to the October peaks were all tech all the time, the rally since, it's been all healthcare, all financials, all materials. And that, in turn, has aided a comeback in the small cap Russell 2000, which has outperformed large caps in 5 of the past 6 weeks. The 15% year-to-date rally has the Russell right now poised for its best annual return since 2020, and Goldman strategists see an additional 10% advance in 2026 on the back of a strengthening U.S. economy. One wild card, though, could be commodities and the impact on inflation and, more importantly, investor psychology. Industrial metals like copper, they've rallied 36% this year, the most since 2009, amid trade turmoil and tight supply. Meanwhile, precious metals continue to move higher. Gold and silver heading for their best years since 1979 amid geopolitical tensions and bets on rate cuts.
Absolutely. What's going on specifically with gold has to be one of the stories of this year, but so too is the U.S. underperformance. And that brings me to the chart behind me. This is fascinating. This is what we're looking at, the S&P 500, the spread to the MSCI World ex-U.S. annual performance. You can see that the U.S. is underperforming by the most since 1993. That is when I came into existence, which is pretty amazing. And you can see that more often than not, it's the U.S. that's outperforming. The last serious string of underperformance that we saw started in about 2002, 2003, when the dot-com bubble burst, and it lasted for several years here, Romaine. So we'll see what next year brings, whether or not we revert back to the normal performance, which is the U.S. out in charge, or whether this is the start of something more serious.
Absolutely, Katie, from one 90s baby to another. No, obviously not. Let's bring Kathy Entwistle into the conversation, kicking us off to the close here on this Monday afternoon. Managing Director and Private Wealth Advisor over at Morgan Stanley. Kathy, great to have you.
Great to be here.
I don't know what to make of this year, because we came in, it seemed like expectations were relatively high. You had a lot of issues with policies coming out of Washington that kind of disrupted everyone's narrative. And then at some point, I don't know, it just kind of found its feet. And I do wonder sort of what drove a lot of that upside and whether that's something that you see continuing into 2026.
Absolutely. It's a great question. And I think a lot of our clients are asking the same question, like, how can the economy have so many challenges and issues in it and have the market go flying upwards? And basically, if you remember, we did have a big pullback in April, and we did have an opportunity to reposition clients there, too, and keep them invested. What's really been driving the market, I think, is a number of things. We've got the idea that there's a lot of cash on the sidelines still today. Another issue would be that AI is starting to take hold, and how people are adopting AI and how they're using it in their companies, their portfolios, makes a real difference. And then generally just long term, looking at where we're going and investing for the future, not for today or yesterday.
Is the future in that AI trade? And I don't necessarily mean like AI is not the future, but in terms of it being investable and having some material returns, you still see the potential there?
Yeah, I think when you look at AI, you also have to consider not just the companies that are creating AI opportunities, but the ones who are putting it into their companies and utilizing AI to become more efficient and more proficient. And that's where we think there's a lot of opportunities in the market as well.
I'm interested on the flip side of that. There are companies that are definitely having their businesses disrupted by AI right now. Are those companies that you can, at this point, identify and then avoid?
Yeah, I guess, there are ways to identify and avoid. It can be a little bit trickier, and sometimes there's a little bit of a roadway that we have to look at from that standpoint. But when I look at, for example, the financial services industry, which I am in, some companies are doing a great job of rolling out AI within their firms, and other companies are a little bit behind. Some of the employees are adopting a little bit faster, and others aren't. And the ones who roll it out and adopt it faster will be able to have better numbers, better results, and therefore the stock price will most likely go up, and those are the places you want to be investing in.
So AI, a big theme, especially as we head into 2026. Another big question mark about 2026 is what sort of the macroeconomic front, specifically what the Fed trajectory is going to look like. And, as you sort of weigh these different narratives, AI being a big one, how does that knit together with what we might or might not get from the Federal Reserve next year?
Well, I think the Federal Reserve is going to give or take depending on what certain areas of the market are doing. Labor is a big issue, inflation is a big issue. So there's going to be things that they're looking at. And we still believe that there will be in the early part of the year some cuts. And once they start seeing things settle in a little bit more, we might see a little slowdown. So we're looking for some cuts earlier in the year, and that should help the small caps that you were just speaking about, and we're starting to see some momentum there. We are positioning clients in that area of the market as well. And also, it will help just generally the market move in the right direction, and the smaller companies and so forth do well.
I do want to ask you about how that folds into allocating to fixed income. I mean, if you are anticipating a drop in, at least in the Fed funds rate and presumably the Treasury rate as well, what does that mean with how you allocate to, and I'm talking, when I say fixed income, I'm mainly talking, public debt markets?
Yeah, well, and actually, for the last year and a half, I've been pounding the table on municipal bonds for our higher tax-paying clients. And if you look at munis, they're starting to get expensive. So if you haven't invested in munis already, it's time to pull that final trigger and get in before next year's cuts start coming and affecting it even further. But
now, is that to lock in the coupon on that? Or is
to lock in the coupon. And also, typically, it should have an inverse relationship. So the actual principal of the bond should go up as interest rates go down. And if you're locked in ahead of time, you should get the value of that as a result.
And it's interesting, you mentioned that you're in financial services. I want to talk about financials more broadly because a conversation we've been having over the past several weeks is the shape of the yield curve and what it dictates for what you might want to look like when it comes to your equity market positioning. And you think about a steeper yield curve should theoretically translate to a rosy picture for financials. I wonder if that's a thesis that you agree with.
Well, what I look at is more in terms of where are the yields going, right? So if the yields are coming down, I think that is a positive thesis for companies and corporations, public equities, because now they can borrow cheaper. Their revenues can, get more robust, and they can report greater earnings. We're starting to see a lot of companies come out and they're not using the words cautious and things like that anymore. They're talking about leaving some of the worry behind and that we're more in an expansion area. So I think that's very interesting too. So it's a little bit of a balancing act, right? Because we want clients to be invested, but we don't want them to be so invested that if we do get a bump or a hiccup or something or unexpected, down the road, that doesn't affect them in a negative way.
Well, that leads nicely to the question I was going to ask you about cash. You were saying you don't want clients to be overinvested. How about underinvested? Because you take a look at the levels in money market funds, you take a look at these very short-dated Treasury ETFs, they are just raking in cash. And I wonder what you make of that with the S&P 500 practically at all-time highs here.
Yeah, I actually think it's a terrible idea to have your money so short, unless you have a very big expense coming up in a year or less. Otherwise, you want to have that cash invested at least a little bit longer into a little bit more duration, not so limited in short cash duration. People are already missing it, right? We've seen a few cuts already. They're getting paid less now on the cash that they have. This is going to continue. This is not going to change.
Does it surprise you, though, that we haven't seen more of that cash being pulled out of those instruments and into actual risk assets?
Yeah, I'm not sure if it's just like latency and people aren't thinking about it. So I would say, if anything, start thinking about your cash and not leaving it sitting around slowly decreasing what you're collecting on it and find things that you can put out a little bit further, not too long. We like, the middle of the curve, the belly of the curve, and you can ladder. You can do a little bit of laddering so that you have cash coming due at different times, so you're not caught like fully invested, but you're not caught like so short that you're not getting paid for it.
Kathy, that's a good place to leave it. Great to get some time with you before a year's end.
Thank you.
That is Kathy Entwistle. She is Managing Director and Private Wealth Advisor over at Morgan Stanley. Meanwhile, switching gears here to one of the big stories of the day and pretty much of the last couple months and probably the next year. That is the battle over Warner Brothers kicking into high gear with Oracle's Larry Ellison offering to personally underwrite Paramount's bid. Ellison agreeing to personally guarantee $40.4 billion in equity financing for Paramount's $108.4 billion offer. Joining us live to unpack the latest developments is Ross Gerber. He is co-founder, president, and CEO of Gerber, Kawasaki Wealth and Investment Management. Ross, great to have you with us. You told some of our colleagues on Bloomberg Television earlier this month that taking a look at Paramount's offer at the time, that they were pretty much offering to overpay for Warner Brothers. Has your view changed at all?
Well, once again, I think Warner Brothers and Zaslav has done a masterful job extracting extra value out of Warner Brothers, obviously key assets that now these two mega giants want, mostly over power than financial sense, in the sense of paying $100 billion for Warner's when you could pay $200 billion and buy Disney, which seems like a lot better thing. So, this is quite a battle and one that will take some time to see how it resolves.
Well, Ross, to that point, I mean, what do you make of the ferocity with Paramount is going after Warner Brothers? Why do you think they so much want this asset at this point?
A lot of that has to do with the fact that Paramount Skydance doesn't have like a ton of firepower in Hollywood. Paramount was in trouble when Skydance bought them. They have not done very well under Shari Redstone's management, and now he took it over, and it's like, what's the next step I can take to become a powerhouse in Hollywood as fast as possible? And buying Warner was like sort of a coup in many ways, to go from basically almost nobody in Hollywood to kind of one of the biggest players in just a few years. On the other side of the coin, you have Netflix, which has dominated Hollywood for now years and years and has continued to grow and evolve into whether it be video games or sports content, and now looking at buying a studio to release in theaters and all the excess studio content they can generate. It would be a crowning achievement for Netflix to take Warner and be the most dominant player in maybe entertainment business history. So this,
Yeah.
You got big egos, you got lots of money,
Yeah.
you got power, you got famous actors and stars. This is as good a story as you're going to get, and they're going to fight it out to the end because both of them know that this is the future of Hollywood, and whoever wins will define that.
Yeah, the only question, Ross, is when they make the biopic about this, does it end up on Netflix, Hulu, Disney Plus? We'll see. In all seriousness, though, it does get
It'll be on Netflix.
It'll be on Netflix, right? But particularly if they don't get it. I am curious, though, Ross, about the financing structure. And it's hard to kind of wrap my head around what shareholders want. I know that the White House is going to play a big role in who gets this. But when I look at the two deals, it's one thing for Larry Ellison to come out and say, look, I'm going to put up $40 billion to make sure that my boy gets his prize. But when I look at the structure of the Netflix deal, it just seems a lot cleaner. You have the banks involved. They're not diluting shareholders with the lending in the way that Larry Ellison's deal would dilute shareholders. I would think shareholders would want to embrace that, even if the dollar amount might be a little bit smaller over the Paramount bid.
And I wouldn't argue that the dollar amount is substantially smaller either, because remember, you're still getting the CNN assets spun off to you. So I think in actual dollars, the deals are fairly comparable. But what you're saying is 100% true. Netflix has a great credit profile, tons of cash flow. They've just redid their borrowing lines. They're borrowing at a very favorable rate. I actually own a pretty decent amount of Netflix bonds. They used to pay pretty decent yields a few years back. And, Netflix is like a really solid, asset to borrow against. So for them, you also get Netflix stock. And if I'm a Warner Brothers shareholder, which I am not, I would want that couple bucks in Netflix stock too, because why give up all the potential upside that will come with this merger? Not to mention what I consider much more established management at Netflix. When you look at the deal from Warner Brothers, it's just leverage and 100 partners and everybody just hoping that they can, get enough equity capital, which I'm sure they'll be able to do at some point, but they're sort of cobbling together money wherever they can find it. And I still think they need to offer $2 or $3 more if they really want to win this bid. I don't think they're going to win head to head. And I didn't get the impression that Trump was so happy with the Ellisons taking, CBS and everything after, some of the reports that he was unhappy with or whatever.
Yeah.
So, where this goes, I think Paramount is the weaker player here and Netflix is in pole position and they need to come up with more money somehow to really make it that much better than Netflix, or else I think they're stuck.
I am curious with regards to the cable assets and news and cable assets, Ross. I know Netflix doesn't really want them at all. Paramount looks like it's willing to take them on, though there's been some speculation that they would just probably end up pawning that off to someone else. Do you see any real material future for those types of traditional cable broadcast assets? And I mean that from an investment standpoint.
Right, and you're talking to
and
somebody
be careful
who's
who you're speaking to
invested.
here, because this is my job.
Yeah, no,
we're
I
talking
mean,
about.
I have an investment in Disney that's underperformed for a few years, and they were really on track going into 21, and then when 22 hit and things changed, Disney, really hasn't recovered. And so when you look at cable assets, that's the number one reason. You see Comcast spinning off Versant as well, which is CNBC and other cable assets. And I think that's what Disney needs to do as well. But, cable in my mind is a victim of its own problems now, because if this has gone on long enough, that companies like Spectrum have done, I think, a great job adapting to the future. But the bottom line is consumers are just looking for choice and lower costs, and cable just never really adapted to the lower cost model. So that said, it probably costs more money now to watch television than it did when cable was the only guy around when you add up all the subscriptions. So the bottom line is cable is dead. My kids don't even know how to turn it on. They spend a lot more time watching YouTube than anything else. And when you look at the future, it is not people buying cable. And that's just a fact.
Yeah, absolutely. And on YouTube especially, it feels like it's eating everything. But Ross, I actually wanted to go back to a point you made on Netflix, actually, that you're an investor both in the equity and the debt. I find that really interesting because that's a question that a lot of investors confront when they really like a name. So I'm just curious what your decision tree looks like when, you're making that choice between, do I buy the shares or do I buy the bonds?
Well, at GK, my firm, we are one of the few firms that actually buys individual equities and individual bonds in our clients' portfolios. And we really have to work a little bit harder for our clients to get better returns potentially, as well as eliminate a layer of cost with bond funds and things like that. So I spent a pretty decent amount of time buying bonds, actually. And over the last few years, when yields soared, it was just like this unique opportunity after 20 years of low rates. So a lot of times what I do, I already have the analysis of the equity, so I know the financial conditions. So when I can find yields on bonds from those same issuers, I can collect income from, I like to do that because the work is already done and I already believe in the security because I own the equity. So I find owning debt a wonderful way to complement your equity exposure when you want income, like in your IRA account, let's say, where it's tax deferred or tax free in a Roth IRA. So these are more advanced strategies we use at GK for our clients to try to do better for them. And that's why we own a good slug of Netflix bonds that we bought, I think, around the 6.5% range, which is a very good return now because we've made principal gains as well as collecting the interest.
All right, Ross, always a pleasure to catch up with you. Ross Gerber, co-founder, president, and CEO of Gerber Kawasaki Wealth and Investment Management, as we continue our coverage here on The Close with a closer look at a year-end read on retail. The lion's share of the holiday shopping season behind us, but what awaits us up ahead? Eric Fisch going to be joining us in just a second. Stick with us. This is The Close on Bloomberg. Time now for our top calls. The big movers on the back of analyst recommendations. And we start off with Cummins. Raymond James upgrading the maker of truck engines to outperform with a new $585 price target. The analysts seeing glimmers of hope for an eventual truckload rate recovery. Those shares up for a third straight day, heading towards their best year since 2016. Next in line, Hut 8. Benchmark boosting its price target to a street high $85 after the Bitcoin miner signed a $7 billion deal to boost its data center business. The firm maintaining a buy rating, citing Hut 8's evolution from crypto to broader digital infrastructure. Those shares up about 16%, adding to a 150% run on the year. And finally, Ollie's bargain outlet, Loop Capital, raising its recommendation to buy. The firm expecting solid holiday sales, noting more consistent store visits and a more data-driven approach by management. The share is getting a modest bid on the day, up about 2% on the day, flat on the year. And those are some of our top calls. Now, we do want to say in the retail sector, particularly in these waning days of 2025, S&P retail is up a little over 3% year to date, facing potential headwinds from light year-end trading volume and bargain hunting consumers. To give us a little bit more insights about how 2025 shook out and what to expect in 2026 is Eric Fisch, National Head of Retail and Apparel Banking over at HSBC. Eric, great to have you here.
Thank you.
This actually seemed like a relatively decent year for apparel, not only just for kind of the traditional makers, but, kind of the comeback stories that we've seen, and, Abercrombie, even Macy's finally seems like it, at least for right now, has gotten its legs back. Give me a sense here as to what's driving this. Is it just a broader story, or is this management specific in what these companies have been doing?
Yeah, I think the industry overall has performed pretty well, and that's off of in the spring when we thought it was not going to be a great year coming off of tariffs. And I think it's a number of factors. One, the consumer remains resilient. People are shopping. They return to stores. Even with slight price increases, they continue to shop. At the same time, companies needed to become more lean and be really circumspect about what they designed. And so we're seeing really conservative inventory positions, but at the same time being clear about what their perspective is, what their design is, and it's the consumers responding to that.
Talk a little bit about the inventory side of this, because coming into this year, there were a lot of companies that I was going through, and their inventory was a mess, and their inventory levels were just a mess. And some have acknowledged that publicly, that they're trying to get it down. What actually righted that ship? Was it just basically finding a way to sell off that inventory, or just stop ordering new stuff and sort of let it all balance out?
Yeah, fear. That's what drove it down. Ultimately, when Liberation Day occurred, people expected the worst in the back half of the year, and I think people ordered accordingly. And so we certainly haven't seen this bare shelves or anything like that. But what we have seen is people are going to work through that inventory. And when they don't have any more, they don't have any more. So I'm sure anecdotally you've experienced out of stocks online when you go to shop something. And I think brands are OK with that. And next year they'll order slightly more aggressively as they're more comfortable.
It's really interesting that, this year, the worst case scenarios for retailers didn't necessarily pan out when it comes to tariffs and when it comes to inflation, but it certainly has impacted how people shop. And I'm taking a look at your notes. You make the point that it's discounts, it's value that really is front of mind for shoppers right now.
Yeah, and people want that perception of value. And so what's interesting is that occurs at every price point. So luxury's had a little bit of a rough go over the last 2 years. That shopper, keep in mind, is very often aspirational, right? The vast majority of luxury spending is not ultra high net worth individuals. It's people saving for that one item. They're looking at the price point below that, designer, contemporary, and saying it's fantastic design, it's great quality, a fraction of the price point. You know what, this is as good a buy as is appropriate for me, and they're foregoing that luxury purchase. Luxury's catching up with that.
That's interesting. Talk to us a little bit more about what we're seeing with luxury, because typically the narrative is that, luxury is resilient. And if you enter any sort of downturn, it's typically luxury that tends to sort of hold its share. But it sounds like this environment, it looks a little bit different.
Yeah, I think two things happened. They accelerated price increases a little faster than the consumer could digest it. And there was a lack of design differentiation. We had gone through this quiet luxury period. The problem with quiet luxury is you can't explain. You have to explain to people that you're wearing it. And so I think it created white space. It created a gap in a price point where that lower price point filled it in by sort of elevating their collection, and they got that consumer. Luxury's responded. So to your point, luxury will always be okay because there is such a perception of value, but they are creating products that are going to come down slightly to attract that consumer again.
Let's talk a little bit about some of the off-price retailers. I mean, they've generally held up this year. I am curious, though, about this idea of a trade down. There seemed to be at least anecdotal evidence that people in the higher income spectrum were trading down to some of these discount retailers as they sought out bargains.
Yeah, and I think there's every year less and less stigma around off-price shopping.
Yeah.
The brands you are interested in are there. The treasure hunt aspect is, creates excitement for the consumer. And so more and more people are going in that direction. I think as off-price has gotten the amount of scale it gets, it's also more attractive to my clients, the brands, because your product can get sort of lost in that treasure hunt. You know, if you walk in and you find one item that's a brand you love, that's an amazing find. If you walk in and see a full shelf of it, right, you're like questioning the brand's validity. So given the scale of off-price now, there's no risk of that.
How do you talk to them about it? Because I know I shop a lot online, and I have to say, my perception, like when you sort through things and you see you're just flooded with this one particular brand, particularly if it's a luxury, and you're kind of like, that's not, I don't know.
It makes you question it. I think I have a very smart client that always says that if you have no product at off-price, it means you didn't take enough risk in design. It's an interesting way to think about it, that off-price is an outlet. You should take those risks, broaden your appeal, and if it doesn't work, that's the way you get rid of it.
Yeah. I do want to get your thoughts on athleisure. Really interesting category. We know it's become very crowded.
Yeah.
We also know that tastes have shifted when it comes to athleisure. You think about Lululemon, sort of the move away from sort of skin-tight leggings has been a conversation that's been had. What are you seeing when it comes to athleisure and the shifting sands there?
Yeah, it continues to have really broad appeal. I think it's become the weekend uniform. And so as you think about that, people are broadening their collection of it. And a lot of it's gone from true performance into really loungewear and more stylish, more fashion. I think, to your point, anytime there's a change in trend, it's fantastic for the retail industry. Right? Denim is another example where it went from tight to a looser fit, lower gauge denim, so a lighter feel, and then everyone changes their entire wardrobe. So the same is true in athleisure.
Barrel jeans were hot for a minute. I hope that we're on the tail end of that, Romaine.
I have no idea what those are.
They're just really, imagine a barrel, and then imagine that the barrel was a pair of pants.
Okay.
Looks like that.
All right. So like what my son wears.
Maybe.
You can fit two human beings in one leg.
We'll Google it together.
We'll Google it later. In all seriousness, though, I am curious about new entrants into this space. And it's funny, you mentioned athleisure. We've talked a lot in this program about a lot of the competition to Lululemon, which is kind of credited for, if not inventing, certainly furthering the athleisure market. But then you look at Vuori and Alo and all these companies that probably didn't exist when Lululemon was coming up around. Is there a easier path to entry in the apparel space right now today, or is it just as hard, or in certain cases maybe even harder?
Yeah, easy would be understating it, for sure. Some of these players are highly successful. I think, that's the problem of creating a category and then being hyper successful in it. Others look at it and say,
copy it,
this looks great. But I would be hesitant to say that those two in particular had an easy path to get to where they are. Listen, as I gave the example where luxury increased prices too much, it creates white space. Anytime you have white space in a category, in a price point, in a demographic, others will jump in.
All right, Eric, great conversation. Really enjoyed it. Come back soon. That is Eric Fisch. He is National Head of Retail and Apparel Banking over at HSBC. Meanwhile, we're keeping an eye on these markets. It is a holiday shortened trading week. We'll bring you all the details as we head to the closing bells. This is The Close on Bloomberg.
A little after 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Katie Greifeld. It's December 22nd. It is a holiday shortened week. Christmas is on Thursday.
Are you excited?
I am very
so
excited.
excited. I love this time of year.
You know, the markets are excited as well.
Did you walk around New York City? I'm sorry, you don't live in New York City.
I don't live here anymore.
But if you walked around, and if you actually lived in a real city, and you walked around it, like New York, it's just absolutely beautiful this time of year.
It's so nice
all the
that
lights,
you can tell me about it.
all the people.
Yeah, all the
sure
people.
thing.
You know, they have
the
a lot
windows.
of lights in Hoboken too, but that's a city that sleeps. I'm out there at 8 a.m. on the weekends. No one else. It's just me and the pigeons. Anyway, let's talk briefly about these markets, because we are seeing a lot of dip buying here. We know that we managed to close last week just narrowly in the green. The S&P 500 currently higher by about 0.6%. This matters this week because it'll help determine whether or not we do close December in the green, and it's close.
It is close, and it gets to the idea. I mean, we talk about this phenomenal run that stocks have been on all year long, and it got a little interrupted, obviously, in November, where a lot of people started to rotate out of some of those big tech names. But you're talking about a market sitting on some of its best gains on an annual basis, that above historical averages, and it raises the question: is there any real momentum here that would knock that momentum off? Any catalyst that would knock that momentum off?
Absolutely, you have to think about the AI trade. You also have to think about the economy. We know that there is a bit of a tug of war going on when it comes to inflation, whether or not we could see a little bit more pressure to the upside, and what exactly is going on in the labor market.
You've heard a lot about this issue of the K-shaped economy, particularly as we get more and more data points showing the health of the labor market and everything in between. The most recent data that we got, at least on the labor front, while it did show some encouraging signs, it also showed several disparities, particularly when it comes to certain demographics in this country. We know affordability is shaping up to be one of the hot button issues heading into 2026, with Wall Street bracing for the impact of President Trump's economic policies, as well as a midterm election later this year that could have huge ramifications. Our next guest has been watching the employment picture closely to assess how these cross currents could affect all U.S. communities, particularly amongst Black Americans. Justin Fox joins us right now. He's an opinion columnist for us here at Bloomberg. And you recently had a column, I believe, just last week, talking about some of these disparities, particularly when it comes to the unemployment rate that has ticked up slightly, but it's still in the 4% range. However, if you look at certain demographics, like Black Americans, you're talking about an unemployment rate that's almost double that. Why?
Black American unemployment rates have tended to be higher as long as the data series go back. And there are lots of people have lots of different explanations for it, but clearly Black Americans are sort of have been disadvantaged in getting into the labor market. And so when you see what you've got right now is in the overall unemployment rate, it's up a bit, but there's a lot of stories you can tell about it that, maybe this is just something about, the time of year, the government layoffs, other things.
Yeah.
Black unemployment has just skyrocketed over the past, basically since January or February. And I haven't memorized the exact numbers, but it's like from 6% something to 8.3, I think, in November. And traditionally, people look at that and say, oh, that's a warning sign that things are getting worse because Black Americans are less attached to the labor market.
Do you have any idea why that's skyrocketed? I mean, I've heard theories that some of it had to do with the government stuff, that you had Black people are disproportionately represented in a lot of government jobs as well as a lot of manufacturing jobs, which is
that's what, so that clearly, so it might just be that's this warning signal and unemployment's going to go up for everybody soon. But you can look at what's been going on. One is federal employment, big drop. Black workers are disproportionately represented among federal workers. Among manufacturing workers overall, Black workers are not overrepresented. It's actually a smaller percentage. There are definite specific industries, and I didn't do a whole breakdown. But the other thing is you've had this just really sort of whiplash turn against any sort of DEI efforts to the point where definitely within the federal government, it's like anti-DEI. It's like appoint the dumbest white guy possible. And so I got to think that might be having an impact. I don't have any sort of, there's no way to.
Well, that's the thing, and you write this in your column, that when it comes to the DEI U-turn, as you phrase it, it's really hard to quantify here. But, when we're talking about policies, what might you point to as potentially some evidence?
On that one, all I can say is the rhetoric has changed massively. You look in the federal government, just sort of who's in prominent positions, and there's been a big demographic shift, which you expect a little bit just because the makeup of the different political parties, but it's been more than that. And then, again, just back to federal employment overall, those numbers, I think the federal workforce, when the latest numbers, it's about 19% Black workers, and the overall workforce is below 13%. This is sort of a thing where I was writing in response to the jobs report. I don't have, it feels like a story to keep looking at. because I don't know what the specific things would be, but I think there's probably evidence out there.
Yeah, that column, it was great too, because it gets to the idea, as you were getting at, is this a harbinger? And historically, increase in the black unemployment rate does become a harbinger for the rest of the demographics out there. This might be a little bit more idiosyncratic. Justin Fox, a Bloomberg opinion column, that's a great column last week. I encourage everyone to check out. When we come back, we continue counting you down to the close, and we're going to talk about the big year for quantum computing stocks, and it's getting bigger. If you look on the screen there on a daily basis. We'll be back in a moment with our Stock of the Hour. This is The Close on Bloomberg. Time now for our Stock of the Hour, and we're keeping a close eye on quantum computing stocks like D-Wave. D-Wave Quantum announcing it will have a significant presence at the Consumer Electronics Show, which takes place in Las Vegas at the start of the year. And let's face it, it's already been a banner year for that stock, quadrupling in 2025, with the majority of the sector seeing big gains as well. Bloomberg Markets correspondent Norah Mulinda joins us right now to talk about our sector of the hour. All right. A year ago, if you had asked me what quantum computing was, I would not have been able to tell you anything. I would say it involves some type of quantum leap where a guy travels back and forth in time to solve crimes. But I'm told that's not what it is. I'm also told that this is the next big thing. Is there some sense here that investors have glommed onto this, and I mean writ large with regards to these stocks, as being the next big thing?
Absolutely, and that's what we're seeing reflected in the trade. Everyone's looking for what is the next artificial intelligence play. I mean, you've seen a lot of people squeezing money out of these major big tech companies. So they're looking to see what is the next chapter. How can we be ahead of the curve here? So you're seeing a lot of people pouring money into the quantum computing space. As you pointed out, D-Wave, that's one of the companies that we actually are seeing massive progress in. If you look at it against its peers, we still have yet to see a lot of, essentially seeing something at play here when we look at the names in particular. But when we look at D-Wave specifically, we are seeing the most progress out of that name in comparison to some of its peers like Rigetti, for instance.
So we know that markets are forward-looking animals. They, look into the future and sort of price that reality now. But what does the current fundamental picture look like for a lot of these quantum stocks?
So if you actually look at how much money they're making in terms of revenue, not that much, maybe tens of millions of dollars. So there still is yet to be seen how profitable these companies are actually able to become. So people really are just doing a bet on the future here, perhaps. But if you think about 2025, it really has been a spectacular year as people are looking to other corners of the market outside of just the major tech names to really see where we can see some actual, fruit.
And remember earlier this year, there was a lot of concern about these companies not having any revenue. Right. Jensen Huang had a kind of an offhand comment that seemed to suggest whatever revenue was like, years, if not decades into the future. Although he later sort of walked that back and said he does see something. I mean, we should point out, this is a direct correlation with AI. We're basically talking about computers that basically count things in a different way, but in a way that's more efficient, which effectively allows you to process things faster and more efficiently. Absolutely. Isn't that kind of what AI was supposed to do?
I mean, that's what I thought, right?
Yeah.
But for 2025, we did see a lot of the big tech companies clearly co-signing quantum computing stocks. So while that was actually, a discussion earlier on, you're seeing a lot of the big tech companies hopping in here. You also see the government co-signing this as well. So it definitely seems to be some sort of widespread reception here.
All right, Norah, Mulinda with the latest. The closing bells are up next. This is Bloomberg.
10 minutes until the closing bells. Romaine Bostic alongside Katie Greifeld, kicking you off to the close on the first day of a holiday shortened week. And Katie Greifeld, I was just taking a look at the volume. I'm pretty sure we're the only two people on Wall Street working today.
I think you were looking at the weather, actually, for the coming week. There is going to be snow in upstate New York for those long following at home. But let's talk about these markets. The S&P 500 higher by about 0.6%. The Nasdaq 100 underperforming, which is interesting. It's not all about tech today, but your point is well taken when it comes to trading volume. Not necessarily a lot of conviction and volume behind these moves. Yeah, and we should point out, of course, Wednesday, a little bit of a shorter day, or I'm sorry, when's Christmas? Thursday. It's on Thursday. Yeah, so a short day on Wednesday. Yes. Thursday's closed. Yes. Friday a full day? I couldn't tell you. I'm not working. All right, type into your Bloomberg Go calendar and you'll get all that information. We'll try to bring it to you here. But we close out the year, of course, with a bit of a rally, 3 straight days right now for the S&P 500, locking in what has been, by any objective measure, a very,
good year. Lizanne Sonders joins us right now, Chief Investment Strategist at Charles Schwab, to maybe tell us, Lizanne, if 2026 can live up to what we saw in 2025. When you look at the momentum coming out of this year, Lizanne, are you encouraged?
Yes, but I think you have to look below the surface of the cap-weighted indexes to get a fuller picture, particularly in the last couple of months, where you haven't seen a big drawdown at the index level, even though we've seen some of the mega cap prior leaders go through a bit of a pullback phase. But you've just seen broader participation. Over the last 6 months or so, it's only in the teens in terms of the percentage of constituents within the S&P that's outperformed the index itself. And as of last week, that had run to about 60% of constituents outperforming the index. So we're seeing this broadening out. You look at a day like today where the Russell 2000 is handily outperforming the S&P and the Nasdaq. And I think those rotations and maybe a fuller flavor found under the surface of the cap-weighted indexes is something that will persist in 2026.
What happens with regards to economic conditions, Lizanne, to support that? I know the general expectation is that we will see decent economic growth in the U.S., a relatively stable labor market, and I guess maybe put a question mark around inflation, but nobody's anticipating we're going to see a huge spike from where we are now.
I think there is still some instability from a policy standpoint. And we've been emphasizing that, thinking of the backdrop is more about being unstable versus uncertain. I mean, the backdrop is always uncertain as it relates to policy, government policy, monetary policy. And I think that will still define some of what might be fits and starts and some volatility next year. But I think what's most important for the market is the trajectory of earnings. And that's been an interesting phenomenon over the last several months. So from the early April lows, post-Liberation Day lows, until about August, you had significant multiple expansion. Yet at the same time, earnings and earnings expectations were improving. It's just the multiple expansion trajectory was sharper on the upside. But since August, that multiple has been kind of in a choppy flat pattern, yet earnings have continued to accelerate. So that you could have said in August, boy, we're at this exhaustion point in terms of willingness to see multiples expand. Earnings are going to have to do more of the heavy lifting. So far, so good, because we haven't seen multiple expansion, but we've continued to see the denominator do its job. I think that is key to the market continuing to do fairly well, both at the index level and at the sub-index level, is maintaining that earnings trajectory, which of course is predicated on an economy not falling apart.
Well, let's talk about the earnings outlook a little bit more, because I'm taking a look at your notes, Lizanne, and you write that you're expecting another good year, but maybe the beats won't be as much to the same degree that they were in 2025. So where does that leave us, especially when you consider where the economic backdrop is right now?
That may be why you've had a flatter trajectory in terms of multiple expansion, is because you have a lower likelihood of the excessive amount of beats that we have seen so far this year. Each of the 3 quarters, and I'm just rough estimating this year, you had at the start of earnings season kind of mid-single digit estimates expected. By the end of reporting season, you had more than doubled that, essentially for 3 quarters in a row. I don't think that is something we should expect in 2026. That said, if the consensus is accurate, you do have an acceleration, a slight acceleration in earnings growth in 26 relative to 25, but only a couple percentage points increase. I think that backdrop is fine for the market. I just think you want to temper expectations for the kind of beat rate that we saw, at least in the first 3 quarters of this year. And I also continue to think that the beats will be rewarded, but I think the misses will be somewhat disproportionately punished. I think that is likely to persist in 26.
Certainly a tricky environment for those C-suite executives. But speaking of expectations and whether or not they should be tempered, the story over the last several rounds of earnings has been this focus on CapEx spending, specifically on AI. And it seems like the numbers just continue to get bigger and bigger. First of all, I wonder what you make of that, and whether or not in 2026 we see those numbers start to level off, or whether we see this push from Wall Street to maybe see some ROI intensifies.
I think the latter part is really important, Katie. I think that there is more of a push to actually see the ROI, not only their return on invested capital, but return on incremental invested capital, which is sort of that rate of change measure. But I also think, specific to the comments earlier about the punishment of earnings misses, I think that comes into play with CapEx as well. We've seen certain stocks, Oracle kind of being the poster child of if you start to get a little bit sort of uneasy about the spend or how the sort of circularity of financing in the AI space is now happening more via debt markets versus out of free cash flow. So the story is changing a little bit. What I think maybe is most important from an AI perspective is, and it's supportive of this notion of broadening out in the market, I think there's increasing shift away from the prospects of the hyperscalers, even maybe away from the data center build out and the energy needed for that, more on the adopters of AI, which is across the spectrum of sectors and industries and companies, and maybe analysts forcing the hand of companies to actually put meat on the bones. What has this meant from a productivity standpoint? What has it meant from a profit margin standpoint? What does it mean in terms of your labor costs? I think that is going to be more of the focus in 2026 than where we've been in the last couple of years.
Do you think investors have sort of sniffed that out already, Liz? And I'm talking more broadly speaking.
I think so, which is part of the reason why, if you look at a cohort like the Mag 7, and really only 6 of them are directly tied to AI, none of them are even in the top 20 best price performers year to date. And I think that's another mistake that I find individual investors often make, as they conflate the contribution to returns and the price performance. So here's a for instance. NVIDIA is still the #1 contributor to S&P returns on a year-to-date basis, but it's ranked 83rd in terms of price performance. It's the #1 contributor by virtue of the multiplier of its cap size. It's not the best performer. In fact, what's interesting, I think 3 of the 5 best performers in the S&P are called old school tech names. It's SanDisk, it's Western Digital, it's another S1. Shoot, I'm blanking on the other S1. Seagate Technology. Yeah. So I think even within the whole notion of technology, there's kind of a shift to where can I find other opportunities. None of the Mag 7 are even in the top 20 best performers from a price performance standpoint. So I think that's a support that needs to be, there needs to be more education to investors, because I still think that there's that mindset. The only way I can do well is to be concentrated in cohorts like the Mag 7. That's an institutional problem for a fund manager that's benchmarked against a cap-weighted S&P. That's not a problem for individual investors.
All right, Lizanne, got to leave it there. And we should point out, not in the top 20, not even in the top 30, where you find a Mag 7 name on a year-to-date basis. They've still had some good gains, but as you pointed out, those other names have done a lot better. Lizanne, we always appreciate your contributions to the show. We'll catch up with you in 2026. Lizanne Sonders, Chief Investment Strategist over at Charles Schwab. Katie, counting us down to these closing bells.
Absolutely. And again, we're looking at gains. It's hard to know how much we should actually put into this when you have trading volumes so low. But as I was saying before, this matters for the monthly metrics. If we do close out December, this will be quite a long streak of monthly gains that we've seen on the S&P 500. And where we stand right now, it looks like that's the case.
Absolutely. The S&P trying to push toward an 8th straight month of gains. That would be the longest monthly winning streak going back to basically from mid-2017 to early 2018, and 3 straight days of gains here in this month of December, contributing in a big way to that. As we get the closing bells in New York, you got bars on one screen and clapping on the other. Nevertheless, it is green across the screen. The Dow Jones Industrial Average up more than 200 points, or 0.5%. The S&P up 0.6% on the day. The Nasdaq up about 0.5% on the day, and the Russell 2000, that's your outperformer in a big way, adding 1.2% here on the day. Joining us around the desk here in Studio 2, Norah Mulinda, our Bloomberg Markets correspondent, and Emily Graffeo to help us break down all of the day's market action. And Emily, are you actually surprised by this maybe a little bit of spurt that we've seen towards the end of the year?
Yeah, I mean, like Katie said, it is low volume, so we do have to be careful conflating the action too much. But certainly people are bullish heading into the end of the year, and we always have that Santa Claus rally that comes in a
know
couple
what
weeks
that
from
is.
now.
Yeah.
It has a very technical definition that isn't as fun as the name itself.
That's just a simplified version.
Well, the funny thing is, it doesn't actually really start until Christmas. It's basically
it's like after
It's the last 5 trading days of the year, and the first 3 trading days
We
going
can't be
into
jolly.
2026. But it's this idea that when we talk about seasonality and some of these other factors working in favor of the markets, I do wonder if that ends up being the big tailwind for us into 2026.
Right, and it's interesting if we think about the double-digit returns that we're seeing right now that we're on pace for to end the year. If you flash back to just earlier this year, a lot of bears were not expecting this to be the expectation here. We had bulls and bears not really seeing what they expected here. So
I'm sorry, did Katie talk to the circle yet?
I haven't talked to the circle, and I'm
Okay.
dying to.
What did the circle tell you?
Let's talk about the circle.
Okay.
It shows it's actually really interesting today if we could pull the circle up on screen.
Katie does this alone at home by herself.
Really good breath right now. No, this
Yeah.
is me time with the circle. You can see it's all in green right now, which is really fascinating. But in terms of what was your biggest sector performance, it wasn't tech, even though that's mightily represented there. Financials had their best days from a points basis. That was your biggest gainer. In terms of a percent gainer, it was materials. The lone sector that didn't perform today.
Who's that guy?
Consumer staples.
Oh.
But that really speaks to what we're seeing. When you see a big green circle, it typically means that it's a risk-on environment, and that's typically not an environment where you see staples get bid up.
Yeah, absolutely here. And we talk about all the green on the screen. And just to put a finer point on what you're talking about with regards to the volume, 44% lower than where we were just last week. So that's not even going for the longer term average over the year here. Let's talk about the gainers. There are a lot of gainers out there today. Norah, who you got?
I had a great day. I had a lot to choose from right now. Well, the fight over Warner Brothers Discovery continues. We've been looking at Paramount Skydance all day. Shares of that company ended up about 4% to end the day. And this is after one of the richest men in the world, Larry Ellison. He threw his own personal fortune behind Paramount Skydance's bid for Warner Brothers Discovery. That's about $40 billion that he is pledging to put toward the company. So you were seeing some action here when we look at Paramount Skydance and Warner Brothers Discovery, up about 3.5% to end the day. So we're seeing a lot of action there, especially as we still maintain our eyes on Netflix, which is also, of course, in the action for Warner Brothers Discovery. But let's move over to what's going on in the space sector. I've got my eyes on Rocket Lab. This is a company that's only about $44 billion in market cap, but the company builds and launches the satellites that they put into space. Of course, the main effort here has been to create a world in which there are no sort of telephone coverage gaps. So you are seeing Rocket Lab as one of those companies that has a lot of those satellites out in space. And they won a contract, actually the largest single contract to date for the company. They won a contract to design and build about 18 satellites. So you're seeing shares of that also higher, up about 9.9% to end the day. And lastly, I wanted to end things off with First Solar. This is the biggest gainer in the S&P 500, so had to save the best for last. We've been watching this deal with Alphabet to buy clean energy developer Intersect Power, which is one of First Solar's customers. So you definitely are seeing a lift to shares of First Solar today.
All right. And Emily, you're keeping an eye on the decliners today.
That's right. That's why I wore a red blazer.
Oh, wow. I thought it was just for Christmas.
Well, a little bit of Christmas, but also for the decliners of the day. Lamb Weston dropped to the lowest level since 2020. It's the 4th straight day of declines for the frozen potato maker. They had earnings on Friday that disappointed investors. And then we got a downgrade from BNP today, downgrading the stock to neutral and cutting the price target to a street low of $48 a share.
What's going on? Are we not eating fries anymore? Or what's happening?
So the firm is citing international competition heating up. Which
okay, international competition.
Kind of a
so foreign potatoes are stealing our jobs? Is that what's happening?
I guess so. I think it was more about the earnings, but yeah, they didn't say much, but I did enjoy that heating up pun, because you would heat up your frozen potatoes.
You fry them.
Or you fry them.
Or I guess I'm going back to the start where
both.
you fry them and then I guess you freeze them in Lamb Weston's case. Anyway.
Right. The consumers are heating them after they're, taking them out of the freezer.
Have you ever worked in a restaurant kitchen?
No.
Oh, okay, all right.
All right, let's move on to Target, another red stock, dropping 3%. Target, Whole Foods, and Walmart today were added as defendants in a lawsuit against baby formula maker ByHeart for selling a product potentially contaminated with spores that cause infant botulism. So that stock falling about 3% today, more than Walmart. Target not commenting yet on Bloomberg News' coverage of the story, but keeping an eye on that. And then finally, Netflix was down about 1% today. They refinanced that $59 billion of debt that they are going to tap into to purchase Warner Brothers. The story here, though, that's kind of a market neutral piece of news, but I think the stock was getting overshadowed by this idea that potentially Paramount could win this bid here with David Ellison personally backing that over $40 billion of a commitment. I did speak to one investor today who said, why would Warner Brothers reject the Paramount bid if it's a higher bid? So keeping an eye on that, maybe really not driving Netflix stock lower per se, but that stock was down about 1%.
All right, let's check in on yields. We did see the entire yield curve actually shift higher here on the day, but take that with a grain of salt, because when you take a look at the options market, you're seeing a lot of bets come in right now for a bond rally that would actually push yields lower. In fact, a lot of bets, at least for the 10-year, are that we could see that yield back below 4% sometime within the first 3 months of 2026. Whether that comes to fruition or not remains to be seen, but similar to the equity market, we should point out bond market trading activity relatively light given the holiday shortened week, Katie.
I think we're going to talk about movies now.
Did you go to the movies this weekend?
No, I didn't.
Yeah.
But a lot of people did, and specifically, you guys, they saw Disney's Avatar 3 apparently opening was met with $88 million at the box office. That was the highest grossing film of the weekend, which is interesting because it continues this theme of, sequels and then what comes next, this being the third movie. Did anyone at the desk actually see this movie?
No.
Okay.
Is this,
Wow.
It's not for children, right? It's for adults. Families,
Well, we're
adults, or
We're adults.
No, I'm saying,
that's where you went?
Why did the children matter?
Like, is it a kids
Won't someone think of the
movie?
children?
Because it's characters?
I don't necessarily think so. I think that my understanding is it's young adult and up.
Okay.
What's interesting?
Well, it should point out
We'll
there was also a SpongeBob movie that opened up that did not do well. It actually underperformed for some reason or another.
I have to imagine that was for children.
I don't know. I feel like SpongeBob is more for adults, but what do we know? Anyway, but it gets to this idea, though, of the entertainment industry, particularly you were just talking about, obviously, the whole Warner Brothers, Skydance drama, and obviously a fight effectively over one of the most coveted movie studios out there.
Yeah, and there's a lot of, I think, sensitivity when it comes to movies right now, because obviously this idea that if Netflix wins, if they go through with their acquisition of Warner Brothers, what's going to happen to movies versus streaming?
Do people go? Do you go to the movies?
Then you just stay at home.
Yeah.
I went to see Wicked 2,
Me too.
which, as we're talking about sequels, there was Zootopia 2 that everyone was locked into.
Zootopia 2.
I didn't see that one, but Wicked 2 was great, and I went in person. But to your point, Emily, I think a lot of people just like to chill, get some hot chocolate, be bundled up, and watch something on Netflix at home.
I gotta say, I'm very excited for Marty Supreme. I will absolutely be going to theaters to see that.
Is that Timothy?
That is Timothy Chalamet.
Yeah.
Last year, Christmas Day, I went to see the Bob Dylan movie, the biopic that
absolutely,
he starred. It was great on Christmas Day. Yeah, so this one also premieres on Christmas Day. I don't think I'll actually make it there on December 25th.
Is Timothy Chalamet trying to own Christmas Day? Is he going to be like when Will Smith owned like July 4th? Is that what's happening
next year we'll have enough data to know if it's a trend. So.
Okay. On that note, Norah. Thank you. Norah Mulinda, our Bloomberg Markets correspondent, and our thanks as well to Emily Graffeo, who I think we might be seeing a little bit later in the program. When we come back, we're going to take a closer look at the IPO market through the lens of an exchange. Jeff Thomas is going to be joining us, Chief Revenue Officer and Global Head of Listings for Nasdaq's Capital Access Platforms Division. That's coming up next here on The Close. This is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romaine Bostic as we kick off this holiday shortened week here in the United States. Green across the screen for the third straight day, at least for the S&P 500, 0.6% gain. That gives it a gain of roughly about 2% or so over the last 3 days. And that erases that 2% drop that we saw to start the month of December over those first couple of weeks or so. No record highs for the S&P 500, but the uptick is well. No record highs for the KBW Bank Index, but that uptick is welcome, but you are still seeing a lot of record highs in the commodity space, both gold and silver. Once again, trading at record highs, and so too did copper. Copper over in London at one point, Katie Greifeld, almost cracked through $12,000.
Dr. Copper feeling good. Let's talk about some equities, what some of the big movers on the day. where I'm starting with First Solar and Alphabet. Alphabet out with the news that it's going to acquire Intersect for under $5 billion. Alphabet shares actually rising on that. More so, First Solar up by 6.6%. That is one of the customers of Intersect, so good news there. And then Seagate, this is one of your biggest losers on the day, falling by about 4.6% on an up day. Meanwhile, let's go to our top story this hour, and that is IPOs resurging into the new year. Medline's debut, capping off what was a big year for IPOs and setting the stage for what could be a banner 2026. That, of course, would be led by a potential blockbuster in a SpaceX debut. The Nasdaq, meanwhile, coming off its strongest year for capital raises since 2021, raising more than $46 billion from new listings. Jeff Thomas, he is global head of listings for Nasdaq's Capital Access Platforms division, looks forward to building on this momentum in 2026. And Romain, I think he's sitting right next to you.
Yeah, I'm told he is. In fact, he looks great. Jeff Thomas joins us now here in Studio 2. Great to have you here, Jeff.
Great to be here.
Great year for you guys. I mean, Medline, which of course we were just talking about last week, biggest IPO of the year, but also forgot, you had CoreWeave recently, SailPoint, a few others as well. You've attracted a lot of capital, a lot of new companies here. Does that continue next year?
Yeah, and if you look back over the course of the year, it was a relatively strong start to the year. Then we hit some volatility in Q2, and then we started to pick up some momentum going into Q3 post-Labor Day. Then we had a government shutdown, and that kind of slowed down IPOs again. So great to see the biggest IPO of the year last week. That was following the largest exchange transfer of all time with Walmart. So a great way to end the year.
Yeah.
We did raise over $46 billion through new listings on Nasdaq. That was almost double what we did in 2024. And so as we look ahead to next year, a couple of key trends we're looking. Medline was obviously a big private equity-backed deal.
Yep.
So we're seeing a lot of sponsor-backed activity. We saw a lot of activity in the technology sector driven by the AI boom, so we expect that to continue. And then we just had a biotech flip public today, and so we're hopeful that the healthcare sector will kind of come back.
I am curious let's talk about Medline, because, I mean, in addition to that being the biggest IPO, it's the biggest PE-backed IPO, I think, ever. And it raises the question, knowing how many private companies are out there, how many firms are sitting on companies they want to take public, are you anticipatory that we are going to see a lot more activity from the private capital-backed names next year into public markets?
So I think, during the shutdown, there were some companies that decided to wait till next year.
Yeah.
If they want to go out on their Q3 financials, they have to get the IPO done before February 15th.
Okay.
If they want to wait and go public on their full year 25 financials, they'll probably be more in the late March, early April timeframe.
Okay.
So I think we'll start to see some real strong activity in Q1 out of the gate. And then we expect to see a lot of activity towards the back half of the year as well. So I do think it's going to be a strong year next year.
Let's talk about the extreme end of the scale when it comes to size. Of course, the reporting indicating that SpaceX, that OpenAI are considering IPOs next year. And I'm wondering what courtship looks like of those potential names. SpaceX, I would imagine you have the upper hand since Tesla lists on Nasdaq. But talk us through what that process looks like on your end when you're in competition to bring those listings to your exchange.
When we think about attracting companies to Nasdaq, it's really all about what's the partnership that we can build with those companies for the long term. So I think, we have a lot of fun when companies like Medline go public. The celebration's a lot of fun, but that's really the wedding, and then you want to look forward to the marriage. So how can we help them be excellent public companies? A lot of that starts with the investor relations solutions that we offer to public companies. We actually sell those products and services to companies on both exchanges. That's one of the ways that we form relationships to encourage companies to transfer over. For the biggest companies, getting into the NASDAQ 100 index is a major motivation because that becomes a large passive shareholder in your cap table. But that passive shareholder actually creates a lot of liquidity and a lot of stability in your cap table. And then I think we spend a lot of time talking to companies about how we can align our brands. I think every company wants to be seen as innovative, tech forward. So we spend a lot of time thinking through different ways that we can partner with our listed companies to help them grow their business. Because ultimately, if they do well, we do well.
The NASDAQ 100 is a great point, and certainly that was on full display when we saw Palantir switch its listing. But I warned you that I had a wild card question, and this is it. That you consider, if SpaceX were to go public, what ticker might they want? The ticker SPCX is taken by a very small ETF. If I'm Elon Musk and I want to somehow acquire that ticker, Does the exchange come into that process at all, or do you not want to know about it?
So we can't comment on any specific company, but here's the way that stock tickers work in the U.S. Obviously, if they are currently or actively traded, then there's really nothing that we or any exchange can do. But for any tickers that aren't currently in use, we actually act as the facilitators of a reservation system. And so a company can come to us and we can actually reserve a stock ticker on their behalf. Once we do, it's actually available on either exchange. And then they can have that reservation for 2 years. And so that way companies can plan a little bit in advance. Of course, with companies staying private longer, that can be a little bit of a moving target because as you've seen, companies are waiting longer and longer to go public. And so it's one of the things we talk to companies, we say, well, before you put in that reservation, make sure you're really committed.
Yeah. Although I think if Elon Musk called you and said, give me SPCX, you probably...
Here's a gazillion dollars.
I do want to talk a little bit about another dynamic that we saw this year, and you kind of referenced it with Walmart moving over to the Nasdaq. That wasn't the only company. You had a couple dozen companies that changed their listings over to the Nasdaq. I think Shopify was in there as well, and a couple others. Is this like just the normal, just healthy competition that you're having with the NYSE and the other exchanges, or was there a fundamental reason why you saw so many companies decide that they wanted to move to the NASDAQ?
Yeah, so when a company goes public, they always say they're taking a leap of faith when they select their exchange. Companies that are making an exchange transfer, those are informed buyers, right? They've worked with the other exchange for a while, they know what they're getting. And so it was only been in really the past 20 years that companies could transfer their listing. So before that, you couldn't move your stock ticker, which was a major impediment. And you had to go out and get a full shareholder vote, which was a huge lift for a company to do that. So the SEC determined back in 2005 that was anti-competitive. So they let companies take their stock ticker to either exchange. And they allowed the board of directors to make the decision. So since that time, including Walmart, we've now had over $4 trillion transfer from the New York Stock Exchange to NASDAQ. Importantly, that only counts the market cap on the data transfer. We're not taking any credit for the appreciation they've seen post, many of which have had pretty strong appreciation. And there's been less than $1 trillion that have gone the other way. So really strong testament to the value proposition that we discussed around those investor relations solutions to kind of help companies really understand who's buying and selling their stock, which investors they should be talking to, and how their story is resonating. The NASDAQ 100, of course, has been a big driver of those transfers. We actually have 25 of the NASDAQ 100 are transfers from the New York Stock Exchange. So it's becoming a big motivator. And then I think that brand alignment, right? So when Walmart transferred, they talked about being...
Wait, I'm sorry, you say 25 of the NASDAQ 100, the current NASDAQ 100 members were transfers?
Transfers
oh,
from
wow.
the Stock Exchange, yeah. And so, the last one is that tech alignment, right? So Walmart talked about being people-led but tech-enabled. And so wanting to be seen as future-forward and innovative company.
All right, Jeff, really enjoyed this conversation. Great way to wrap up 2025. That is Jeff Thomas. He is Chief Revenue Officer and Global Head of Listings for NASDAQ's Capital Access Platforms. Also a good reminder, Romain, that we talk about the NASDAQ 100 as sort of being the tech-heavy benchmark, but it's not necessarily just tech. And the Walmart example potentially being added is a good reminder of that.
Yeah, absolutely. And it gets to this idea of sort of what is the true benchmark. I mean, some people would say with the 500 stocks, the S&P is probably more representative. That's certainly more representative than your favorite, which I believe is the price-weighted 30 stock.
The Dow. Don't even talk to me about the Dow. Coming up, Warner Brothers Discovery.
She hates when I do that,
Not
Jeff.
the only company with deal-making headlines that moved markets on this merger Monday. We'll break down all the other action up next. This is The Close. Well, it may be a light day for trading volume, but it's been a busy day for M&A, and not just in media with the latest on Paramount's bid for Warner Brothers Discovery. We also got deal news from Alphabet buying clean energy developer Intersect for $4.75 billion, a Trion-backed group buying Janus Henderson for $7.4 billion, and you also had Cintas proposing a new takeover bid for rival UniFirst. Bloomberg's Matt.
That's a lot.
I know, I'm breathless now. Matt Monks, thankfully, is here to break it all down. I want to start with Janus Henderson because Trion already had a pretty big stake in Janus. So what led to the decision to just buy them outright?
So this has been dragging on since, I think, since October, I believe. Trion has been in the company for quite a while. Really got in there and tried to shake things up and turn things around, pivoting off of its kind of botched merger that created the company, Janus merging with Henderson a few years ago. And it never really just kind of worked. So you kind of created this kind of undervalued asset that's just been kind of hanging out there. And what's really interesting about this, so Trion is doing the Janus Janus Henderson deal. There's also kind of a similarity, which you guys did not mention. Clearwater Analytics is being taken private by a consortium, including Warburg Pincus and Premier. And there's also kind of a similar through read there. Warburg Pincus and Premier are already investors in that company. They're putting together a club deal to kind of take it private. And they're also using some sovereign funding. But anyway, you put these two stories together, you got an undervalued asset, buyers that are familiar with it already, and they're going out and finding the money from sovereign sources. And it's just kind of it speaks to the overall M&A at the end of 2025. If you want to do a nice deal, particularly in something that you're familiar with, you can find the money to make it happen.
What's interesting on Janus, though, is that it was Tryon, I believe, who helped put in place Ali Dibaj, who is the current CEO. And I mean, you take a look at the share performance since he's been at the helm, it's done pretty well. I mean, it's interesting that, now is the moment, since October or so, that they came through and said, we want the whole thing.
Yeah, and it's been a little bit undervalued, right? And now that the idea is, hey, listen, we're going to take it private, we're going to get it off the markets, we're going to, maybe work on the integration a little bit, and now that the time is right.
When we talk about M&A deals, obviously there's been a lot of activity in the AI space, or at least AI adjacent space. Talk a little bit about this Alphabet deal. And everyone is basically just needs power, I assume, at this point.
That's right.
So if you can afford it and you can get it, you take it.
Yeah, it's all about the digital infrastructure. It's all about locking down the power. And it's kind of almost like a real estate grab, right? And also, Alphabet is familiar with this company as well, kind of going back to what we were talking about before. They're familiar with it. They're an investor in it, and they're just kind of getting out front of it. They're locking down the renewable power development, and hopefully just kind of get that in the pipeline. But you're seeing, if you look at all the trends that are just driving M&A, digital infrastructure, AI, power. Oh my goodness, right? So these are all kind of, it's almost like pieces of the same story.
Based on your reporting, though, because it's interesting you talk about how Alphabet kind of basically was buying something new. It had a good. This also raises a question about the Ouroboros that we've seen in the AI space overall, with the chip companies investing in the hyperscalers investing in this, blah blah blah. Do you think that could actually lead to some material M&A activity, or is that these are just one-off investments? They want to keep
absolutely. It's all tied together.
Yeah.
And you're also in an environment where you're seeing it's permissive as well, right? And then a company the size of, this is like a rounding error for them, right? So it's all tied together, and you're going to see more.
Yeah, and you use the word permissive. That's the regulatory environment, and in theory, at least you have that for another 3 years. In theory,
that's what people are saying, right? Listen. $4.5 trillion in M&A in 2025, second biggest ever. It is the art of the possible right now.
I love that. Matt Monks helps cover the M&A and IPO market for us here at Bloomberg. We're going to stick on that topic when we come back after the break. Take a closer look at private markets and a pivotal point as retail investors clamor for a piece of that pie. Sarah Samuels, she's a partner and the chief investment officer over at NEPC. She's going to be joining us in just a second. Stick with us. This is The Close on Bloomberg. 2026, it's setting up to be a huge year, potentially, for private markets. From some of the most valuable private companies getting ready to IPO to institutions granting retail investors the mass affluent wider access. But so-called retail FOMO, the fear of missing out, is stoking concern about the volume of less experienced investors tapping into what is still a relatively complex market. Sarah Samuels joins us right now, partner, chief investment officer over at NEPC, an institutional consulting firm with about $1.8 trillion in assets under management. All right, Sarah, let's start off with the FOMO, because one way or another, I feel like we're going to see these private assets pushed out there to a much broader class of investors. I guess the question is, not is the market ready for it, but are these investors really ready for this?
It's a great question. And, that train has left the station. The vehicles that are being created for individuals to access private markets are picking up momentum. And this is a theme that's absolutely happening. If it comes down to whether retail investors really understand what they're getting, I encourage all retail investors to read any fine print as it relates to these semi-liquid vehicle structures. But this theme is coming at us like a freight train.
I do wonder about that, because, let's just be honest. A lot of individual investors aren't going to read the fine print. Most don't. But it also gets to the idea as to what they're buying. Like, to me, the FOMO was watching the last 20 years, all these guys, and mostly guys in private capital, private equity, making money hand over fist through investments that I couldn't get a hold of. Now they're saying, we're going to give you a piece of it, but it's not necessarily going to be the whole piece. It's going to be paired with maybe public debt, or it's going to be paired with a whole hodgepodge of things. So what am I buying? Am I actually getting the good stuff that they rode the wave up on for the last 20 years, or am I just getting something that's kind of watered down, for the unwashed masses?
It's the right question to be asking, and it's one that we're absolutely evaluating at NEPC, which is what are the return prospects going forward, and which parts of the market do we expect to be winners and losers? So these are all part of a broad mega theme of convergence. And this is really convergence / blurring of the lines. And when we think about that, it's between institutional investors and wealth investors. They're bumping up more and more into each other in the marketplace. And it's between public and private markets. So we all know that the public markets have basically been cut in half in terms of number of publicly traded companies over the last 25 years. Well, at the same time, number of private market companies have increased sixfold over the same time. So now you've got individual investors really looking for that same exposure. It may be slightly different, but what we think is that going forward, the return dispersion between the haves and the have-nots, between the winners and the losers, is going to be greater.
Well, Sarah, when we talk about private markets, it's easy to talk about them as a monolith, but you talk about, the increasing interest when it comes to wealth, when it comes to sort of the mass affluent and retail investors. What exactly are we talking about? Are we talking about private credit? Are we talking about private equity? Are we talking about real estate? What specifically are we seeing that demand for?
So the really ultra high net worth investors have been investing in private market, traditional closed-end vehicles for some time. What we're talking about here is this evolution of semi-liquid offerings. And these are things that are registered with the SEC. They have periodic liquidity. They have much lower minimums. And they are going to offer varying degrees of private market exposure. The best fit for these types of semi-liquid vehicles are things that are throwing off some sort of income or cash yield. And so that's going to be something like a credit or potentially, a real estate or offering. But for the most part, what we're seeing in terms of capital formation in the interval fund and semi-liquid fund space is predominantly private credit.
Yeah, it's interesting. Specifically on interval funds, it's been a record year of launches there, which really speaks to this trend. But I want to talk a little bit about secondaries. We certainly saw interest for secondaries multiply in 2025. I know State Street Investment Management took a stake in Collar Capital, for example, to really harness that secondaries trend. Where do you think that goes as we look into 2026?
So a second major theme that is presenting opportunity everywhere for any investors, but you have to be on the right side of it, is pressure to transact. So this pressure to transact comes from LPs looking for liquidity that they were counting on to support their operating budgets, comes from GPs needing to manufacture some distribution of paid-in capital, or DPI. They're doing that through continuation vehicles, which are called GP-led secondaries. And it's through these semi-liquid funds having nearly insatiable demand at times to put hundreds of millions of dollars to work in very short order, and they're the buyers in the secondary market. So essentially, the secondary market is deep. It's been destigmatized relative to what it was 10 years ago for LPs in the marketplace, institutional allocators, to price their portfolios and think about strategic secondary sales. And it's something that we really think is that secondaries are now a primary tool for investors. They're not going away.
Absolutely, Sarah. And it gets to the idea, though, too, as we start to see potentially this broadening out of the retail class, I am curious as to how prepared some of these companies are for that, because, selling a single product or a suite of products to LPs, institutional investors, the pension funds, wealth funds, family offices, et cetera, is one thing. But having to parse that out among individual investors becomes a little bit more complicated. And I'm wondering if these companies, if they already have the back office ready for that, and for that matter, the lawyers as well. The idea that they're taking on something that just frankly is going to be a lot more work.
Well, luckily, these private companies are smart, and they know where their shortcomings are and their areas of strength and weakness are. And what we've seen is a tremendous amount of partnerships between public market-oriented asset managers and private market institutions. Sometimes they're mergers, sometimes they're just joint ventures or strategic partnerships. And that's where this convergence is really happening, this blurring of lines. It's another way that we're seeing this with the public and the private managers collaborating so that they can offer something that's strong and cover each other's blind spots to bring things to the retail market.
When it comes to the retail market, this is a theory that Eric Balchunas from Bloomberg Intelligence bats around a lot, that it feels like, especially in the ETF landscape, and we're going to talk about this in a couple of minutes, that issuers seem to want to make private credit as, sort of the area within private markets that they package into the ETF vehicle. But for the retail class, the sort of narrative there is that they really just want private companies. And I wonder, when you look at this specific cohort, what you're seeing there when it comes to interest.
So interest as it relates to ETFs and interest as it relates to anything, registered or interval funds on the private credit side, there is a lot of interest from the underlying wealth investors. They really enjoy the income that gets thrown off, and it de-risks the position, and you get capital back much sooner than others. What we would recommend for anybody playing in the secondary space or looking to make money in private markets is to be a seller of plain vanilla large positions in companies, whether it's on the debt or the equity side, and to be a buyer of smaller and more complex positions in the secondary market.
All right, Sarah, really great to get some time with you. Happy holidays.
Thank
That
you.
is Sarah Samuels. She is partner and chief investment officer over at NEPC. Meanwhile, as we were mentioning, retail investors may be more careful than Wall Street thinks. Flows into State Street's private credit ETF, ticker PRIV, have faltered recently under pressure from SEC scrutiny and a seeming lack of investor interest. Let's bring in Bloomberg's cross-asset reporter, Emily Graffeo. So I called it a private credit ETF there, but the name is public and private credit. So just to set the scene here, how private is this private credit ETF?
So in reporting this, I spoke to people who had maybe different definitions of just exactly what private credit constitutes. One analyst said really only about 8% of the fund is most similar to how an LP would invest in private credit. State Street and Apollo themselves, but mostly State Street, their website says that it's about a 20% allocation to private credit. Again, the ticker is PRIV or PRIV, but that's right that it does have publicly traded debt in addition. And their prospectus says that it can invest generally, it's going to have about 10 to 35% of private credit. It can be more. But what I found in reporting this story was I spoke to a number of financial advisors who said that, one mentioned, I don't really want a fund that does both. I want my private credit allocation to just be private credit. I don't want it diluted. Other people said this is a little too complex for retail and advisors, and then...
But that gets to the idea. I mean, it's a good point. I mean, a lot of people want exposure to private credit because they want private credit. They don't want the diluted version of that, which I know they have to do in order to increase the liquidity. But it gets to the idea, how transparent are the holdings in terms of knowing what's in there? And to Sarah Samuel's point, the idea, is there fine print to even read where investors can actually see what they're getting?
There is fine print. To State Street's defense here, if you go on their website, you can click through the holdings, particularly the ones that have been sourced by Apollo. You can see some details about some of that private debt. But even then, I even spoke to one financial advisor who owns the fund for his client. He pointed out that this is not really going to be a core holding. One, he said it's too expensive to be a core holding at 70 basis points. So this idea that it's public and private and it's all in one and it's a core fixed income strategy, he said, I like it, it's outperformed the benchmark, but I don't know if I would want this as a core holding for my financial advisor clients.
Right. It's a fair point. And also, when we're talking about how there's been seemingly muted investor interest, it's probably worth mentioning that this launched amid some controversy when it comes to the SEC. And I know that you were following that closely at the time. So how did it actually get out the door, and has that created a bit of an overhang over this product?
One could argue that it created maybe a chilling effect in flows. I mean, State Street has addressed the regulators' concerns. If you go in the filing, you can see that even the SEC has said, okay, we have no further questions. But sure, I mean, they had this big debut. They had this press release that said we're democratizing access to private markets. You had the ticker again, and then there was this negative overhang. But so far, there haven't been any regulatory concerns. Everything that they had about the name of the fund, the liquidity, the valuations, those have been solved. But again, $45 million in net inflows compared to $1.3 trillion of net inflows into all ETFs. So it's really been a small sliver so far of just how much retail really wants to buy this.
Yeah, the numbers certainly don't lie. Emily, a great story here on the Bloomberg terminal on State Street's private credit ETF. Stalling out here in a year of industry snags. Bloomberg cross-asset reporter and ETF reporter Emily Graffeo there. Let's check in on the broader market right now, Katie. We did have an update here for most of the major indices here. Third straight day of gains and maybe potentially a nice capstone to what has been a relatively phenomenal year.
And it's really interesting to see the S&P 500, the small caps, the Russell 2000, higher today pretty healthily. But at the same time, you saw a big rush into gold. You also saw a rush into silver. It feels a little out of sorts here.
Well, that's what I'm curious about. It's like on one hand, you have risk appetites clearly still there. But on the other hand, you have a lot of people looking for some modicum of safety. And I wonder if those are the same people, that meaning they're using these commodities and maybe some of the other measures as a hedge, or whether these are just your pure, bears out there basically saying the sky is going to fall.
It's a great question. I mean, you can lump in money market funds and this bid for cash, too. It's definitely one of the stories of the year, one we're going to be following through the year's end.
Absolutely here. All right, we're going to need to take a quick break, Katie Greifeld, until we have commercials. But when we come back, a conversation about the health of the real estate market. Stick with us. This is The Close on Bloomberg.
Well, the United States and Europe are going full steam ahead into the data center gold rush. That rush has just entered its next phase of growth, with most future projects now coming from outside of the big tech sphere. Joining us live to track that and other key trends shaping the real estate landscape is Elizabeth Bell. She is co-head of real estate at the private markets firm Hamilton Lane. First thing, Elizabeth, great to see you.
Thanks for having me. Great to see you.
Let's talk about data centers. One of the first lines in your notes in bold that there is no data center bubble right now. That might stand a little bit outside of the recent consensus that we've heard.
Yeah, I think we approach it from the real estate perspective. So we're investing in real estate buildings and data center buildings. From that side, you want to say, okay, what's going on with supply and demand? And when you look at it, the demand side is going gangbusters. Since 2010, demand for data centers has increased 200%. And most of that was being driven by the cloud computing and digital transformation. And a little bit of AI is starting in now. What we see looking forward as this AI trend continues, and think about it, we're on the cusp of AI adoption. That will take off. You need so much more computing, and the supply is just not keeping up with this demand.
Well, take us into the due diligence process, because we talked to a lot of folks here on The Close and elsewhere on the network that there is this concern that, there could be overbuilding underway. That I hear what you're saying when it comes to the demand right now, far outstripping supply. But you think about technology, it tends to get smaller over time. So it's hard to estimate, the physical footprint needs. And, I wonder how you approach that question.
Yeah, I think we try to strip away some of the technology, bigger themes, and really look at the real estate fundamentals. And getting back to that, when you see the supply, it's under 2% for vacancy is under 2% for most of the market. And you look at a market like Virginia, it's below 0.5%. So we feel good about that. When you look at the forward growth, we're looking at partnering with groups that are doing build-to-suits. So you're not taking on speculative risk. And they're mostly working with the hyperscalers and big credit names where you're securing long-term leases, 15, 20 years. They've got escalators in place. And they have, great underlying credit quality of the tenants. So we really do believe in the space long term.
So that's obviously been a big theme for 2025. I'm sure it'll be a big theme for the next couple of years minimum, at least. I want to talk a little bit more about multifamily housing, particularly given that we sit here in New York City. We have a mayor who's going to be inaugurated in a few days, who ran on a big platform of housing affordability, trying to create more housing. From an investment standpoint, particularly from Hamilton Lane's investment standpoint, do you see opportunities in that, particularly here in New York City?
Yes, we remain very bullish on New York City multifamily. Again, getting back to the supply and demand fundamentals, there's not enough housing. There's a housing shortfall in New York. We're seeing very strong demand come back. Don't bet against New York. The city is thriving again. And where we see actually Mandami come in is creating a great buying opportunity today. So we've saw prices reset. valuations went down after the rise.
And when you say buying opportunity, buying existing multifamily properties?
Yeah, it is still very difficult to develop new.
Yeah.
But on the existing, you kind of have the benefit today of a price reset after the interest rate hikes. So you're at a better basis. And then I think there's a lot of fear in the market with Mondami, especially if you have a mixed building with some, rent stabilized and free market.
Yeah.
So we just make sure that we're buying right and underwriting potential zero growth.
But I am curious about that mix, though, because I mean, for those who don't understand the New York, I mean, basically you can have a building where you have market rate rents and at the same time have what they call rent stabilized rents that effectively are capped as far as how much they can go up. His whole platform, though, is, I guess, trying to maintain that cap and in some cases lowering that cap to a certain extent. So how do you make that profitable? I mean, how do you know if you're going into a project that it's going to be profitable?
So when we're looking to buy existing assets,
Yeah.
you look to see the mix. We're not targeting anything that is, has too much rent stabilized, because there is risk there, and it will cap your rent growth. He can influence the rental rates through the rent guidelines boards. And, he's going to start to nominate people to that board. So we will have to assume in our underwriting 0% rent growth for anything that's rent stabilized. But if you go in at an attractive entry basis and you still have a great proportion of free market rents, you can grow those and still achieve a great return. And the debt is becoming much more competitive for multifamily today. So you're getting a really nice spread on your yield spread over debt.
So high conviction when it comes to New York City. Let's talk about the other end of the country. Let's talk specifically about San Francisco. We know it's been a turbulent couple of years for the city, also turbulent couple of years for the city's real estate. What are you seeing there now as we head into 2026?
So seeing is believing. I went to San Francisco earlier this year and seeing what the new Mayor Lurie did, where he's cleaning up the market. He's being much more centralist in his views and policies. He's welcoming the AI companies back. It was very vibrant. I was there a few months ago, the cleanest I'd ever seen San Francisco. So that helps in this kind of change towards, do people want to live there? I think we're also seeing general, obviously, AI growth. I think we are a little skeptical or cautious as to what that means for the city there, because that is where valuations of public companies influence what people are being paid, what they can pay for rent. But I think it's still a strong market today. So cyclical, you want to get in, get out. But then you also look at, what's going on with back to office. People are there. People are going back into office. We joke, the people at the AI companies are going in 6 days a week now, 7 days a week. So we think it's a great entry point, again, given that the city was hit hard. But we like that, and I think we'll be much more cyclical and quicker to sell once we achieve our return targets.
I am curious, though, too, when we talk to a lot of real estate investors, a lot of them shy away from places like New York and San Francisco, not because they're uninvestable, but because they find better opportunities in the Gulf Coast and the Sun Belt type of states there. Are you actively involved down there, and what's the relative attractiveness of those areas to a major city like New York or San Francisco?
Yeah, Roman, that's a great question. Yeah. And I think a lot of real estate investors, especially during the pandemic, flocked to the South, to the Sun Belt markets that had high growth potential, lower cost of living. However, unlimited land, right? Or unlimited land. What we love about a New York or a San Francisco is the high barriers to entry. It is very difficult to build in those cities. You look at Manhattan, it's on an island. You've got San Francisco with topography there that makes it difficult to build. And those are strong markets that, even if there's not a lot of growth, there's a significant population and housing shortage to begin with. So today, then get to your point about the pricing. Yeah. It was a little bit cheaper to build in the Sun Belt, or better price attractiveness to do that. But today, because of the reset in values, you can get in at New York City at a great value, and we believe in the city long term. We'd prefer to invest there today.
All right, Elizabeth, this is a great insights, great roundup here, and we got to catch up with you in 2026 to see how things are shaking out. Elizabeth Bell is the co-head of real estate over at Hamilton Lane. As we wrap up our coverage here on The Close, when we come back, we're going to set you up for what to watch over the next 24 hours. This is Bloomberg. Welcome back to The Close. We're going to set you up for what to watch over the next 24 hours on what is going to be the eve of Christmas Eve. Katie Greifeld. And we start that eve in the morning.
I am so psyched for Christmas and also for U.S. GDP dropping at 8:30 a.m. tomorrow morning, paired with durable goods. So a nice smattering of data to get you started. And then there's more at 9:15.
Yeah, and we talk about this idea of an economy that everyone's trying to parse how strong it is heading into 2026. The industrial production numbers might give us a little bit more of a sense of that. Obviously, we're a consumer economy, but the industrial production numbers still have a big effect here on the economy.
Absolutely.
But what about 10 a.m., Katie Greifeld? What are you doing at 10 a.m.?
Well, 10 a.m. I'm going to tune in because we're going to get the Conference Board consumer confidence figure. So you're going to get some hard data in the morning, some actual numbers, and then you get the survey, more sentiment types of figures coming through. And it's always interesting to, try to draw lines between them because it's not always exactly what you might expect.
Absolutely. Sometimes those lines are a little squiggly.
Yeah.
Katie Greifeld.
They don't go where you would expect.
2 shopping days until Christmas. Balance of power. They're coming up at the top of the hour. This is Bloomberg.